Introducing Silver Biotics, the preferred colloidal silver supplement of the doc. See silverdoctors.com for details and special promotional offers today, including a specially formulated 30 parts per million, only available from the doc and other healthcare professionals.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, we warned listeners last week that a retest of the April lows was likely on Sunday night's Globex session, and we saw exactly that with a 10% smash in silver in only 4 minutes, retesting the lows near $20. And silver then had a sharp rally on Monday, and at one point was up a pretty large 7% off of its overnight lows on the overnight Sunday session. We saw a second smash on Wednesday, coinciding with Bernanke's speech in the morning and then the release of the Fed minutes in the afternoon. And that was in the face of, even though the Fed appeared to back off their mope of QE tapering here in the next few months or this summer, they had to back off that rhetoric a little bit. But still, we saw gold was smashed back under 1,400, where it was held in check really the rest of the week. And silver back to about the $22 level on Wednesday, where it was trading at just about $23.50 prior to the attack. So we seem to have closed the second half of the week in a range trade consolidation zones. What's your take on the metals action this week, Eric?
Overall, it was productive in my opinion, because I think the biggest story for the week is that the cartel failed on Sunday/Monday morning to induce another round of short selling by hedge funds and other speculators. The interesting time frame between, say, the beginning of London trading on Monday morning and then throughout the whole period leading up to the London PM fix had relatively quiet, but nonetheless an uptrend visible within both price of gold and silver. There wasn't any huge shifts or anything like that when it comes to the patterns that you typically see when the cartel is actively managing trade. So, the whole time leading up to the open in the COMEX trading in New York and hedge funds watching their positions as this is going on as backdrop was pretty telling. You had the huge smash down, and then relatively quiet accumulation, which by the time the PM fix rolled around in London, scared the heck out of all of the hedge funds, and they started to cover in North American trade. And that's a pretty telling switch when it comes to the sentiment of the market. If you try to get a feel for the character of what's going on, it's kind of like the mercantile sense, as James Sinclair speaks about it. That, to me, signals that there's something going on underneath the carpet here. And for the better part of the last 6 months or so, we've seen an increase at the margin of hedge funds going shorter and shorter, and the bullion banks actually trimming their short exposure when it comes to the data that's reported out of the COMEX. And yes, there's questions as to the integrity of that data, and any given specific COT report, any given specific week can give you a different take in terms of its trends, but the overall big picture has been that the bullion banks have kind of cajoled and inspired the hedge funds to act like Pavlovian dogs and taking on greater and greater short positions, as we've seen in the last month and a half with this cascade sell-off, and now the second testing. A double bottom is what we're looking at here, and whether or not it holds, time will tell, but I suspect that it will hold because it looks like the hedge funds are in the mode of actually beginning to trim their short positions. So the partner in crime to this whole effort that the bullion banks have orchestrated is beginning to get a little tired. And, we see this whole propaganda meme with the Fed speak, and another great example has been how Bloomberg in particular, but other media outlets have been spinning this whole George Soros story, and you can kind of get a sense of where the mainstream media's zeitgeist is, for lack of a better way of putting it, when you look at examples like that. The bottom line is that sentiment is at its absolute bottom for this whole entire bull market period. I mean, no matter what you look at, it's probably at the bottom for any given specific measure, but when you take them all collectively, we're certainly at the worst when it comes to sentiment at any given point throughout this whole bull market period. Fundamentally, as we discussed a lot last week, nothing has changed. I mean, the whole picture for the bullish factors for gold and silver remain in place. We have the long-term bond market. If you look at the 30-year bond pricing, it's beginning to fall. And in other words, yields rising because they move in an inverse pattern. It's the 1st of May. They started prices on long bonds started turning down, yields going up. There just seems to be greater sense of stress just below the surface in the markets. When you look at things like Japan freaking out and having a decline of 7+% in the Nikkei, earlier this week, and bond markets beginning to slip out of the grasp of the control of the Fed when they want to, manage long-term interest rates. It's just I think that we're sitting in a calm before the storm, and frankly, I'm not surprised to see hedge funds begin to cover their positions.
And it's interesting you use the term calm before the storm because it really plays into what we're seeing in the physical market side of things with SD Bullion. Sales have calmed down quite a bit in the last 2 weeks, and really over the last week, retail sales at SD Bullion are down quite a bit, and really across the whole industry. As on the show, we've been tracking premiums and shortages at a lot of the major wholesalers and distributors and suppliers, and the premiums have continued to come down this week. They did spike up briefly on Monday after a Sunday overnight smash, but really it was about a one-day spike in just premiums, and then continued to tighten up a little bit throughout the rest of the week. Finally, we actually have 3 or 4 of the primary dealers for the Silver Eagles are now live on Eagles, meaning they actually have inventory in stock that they're selling rather than selling out future allocations, and we haven't seen that in a couple months. Also, again, about 3, 4, 5 of the primary dealers have Maples in stock, and premiums are coming down quite a bit. I'd say about over the past week, probably another 50-cent drop in the premium on the wholesale side for both the Eagles and the Maples. And even a couple of the wholesalers have 90% in, and don't remember the last time any of the wholesalers have had 90% on hand currently. So.
And what's the premium on that, just out of curiosity?
It's come down from the wholesale. It had been running about $5.50, somewhere between $5 to $6 over spot, and it's come down just under $4 over spot now on the wholesale side. So it's come down by about a third, really, over the last week and a half, 2 weeks.
But then again, from the perspective of like the last 5 years or so, $4 over spot on junk is pretty, for 90% silver coins, that is, for the people who don't know what we're talking about. We're talking about United States pockets change from 1964 and below for everything except for the nickels.
Like you said, in perspective, about this time last year, on the wholesale side, 90% could be obtained for about 20 or 25 cents under spot. So it's well over, still about $4 higher or more than this time last year. So, but off a little bit from the extremes we saw really mid-April through the first week of May. So.
And again, for our listeners too, we've speculated that this would be something we probably see. It's not too surprising simply because the North American market, people who are interested in bullion are basically all in. I mean, there are not a lot of people in the gold and silver market in the North American context, but if you look in Asia right now, there are still primary channels throughout the distribution system that are unable to deliver the amount of gold and silver that's being requested by bullion dealers and by jewelry merchants, and even central banks are probably not getting the full allocations that they'd love to be able to get if it was available for them to take it off the market. It's this rather peculiar situation continuing on where we continue to hear that, we're in a bullion bear market, but in fact, have you ever heard of a bear market where people can't actually acquire the product that they're trying to buy? And premiums still remain reasonably high in Asia as well too, but the premium doesn't really do you much good if there's no physical allocation to meet a contract anyway. It's a strange situation how the West can almost live in a Orwellian alternative universe, but in reality, I don't see anything that suggests that this is the death of the bull market, and it's going to be just a question of time as to when, in fact, the North American market fires up again. And I don't see how it's possible, if the bullion banks wish to see lower prices, that they will blast some cannons and create some more short selling and push things down. But as we saw last Sunday, that comes with a very significant risk. It periodically backfires on them, as it did on Sunday. So they're going to be thinking twice before they pull that trigger again.
Right, so I'd agree with you. It sure looks like the calm before the storm here on the U.S. retail side. Well, Eric, I'd like to segue a little bit into what I think is one of the biggest stories of the week that Bloomberg broke this morning on Friday. Europe, the European Union, is reportedly considering shutting down rehypothecation in the 80 trillion shadow banking system. And I just want to read a sentence or two here from the Bloomberg story. It says, quote, the reuse of clients' assets poses a potential threat to financial stability should one of a chain of firms that handled the securities go bankrupt, according to the document prepared by Commission officials and dated May 15th. Uncertainty about who holds an asset can fuel panic in times of market stress, according to the paper. So the European Commission is essentially stating that banksters' rehypothecation of assets could pose a potential threat in an unstable market crisis, which is exactly 100% correct. But as you and I know, Eric, and as well as all of our listeners as well, if they actually attempted to implement this and shut down the banksters' rehypothecation of assets, the whole musical chairs game just ends instantly overnight.
Yeah. And you got to laugh, too, because, I mean, this is a perfect example of how you'll get some politicos and bureaucrats doing the best that they can do when it comes to how they see the world. But it's obvious that they probably spend, no more than 5 minutes when it comes to doing any kind of trading in their past and their own financial management of their own lives. It's obvious that they don't understand exactly what they're talking about. I mean, to have a request for clients to be able to reuse their asset in any kind of hypothecation and rehypothecation scheme is not something that's a typical thing within, say, the City of London and the trades. You can basically have an unlimited amount of rehypothecation when it comes to funds that are invested there. And if you think that bullion market is strange with 100-to-1 leverage, well, all of these financial institutions have this spiderweb interconnectivity of the leverage system to the point where they can't unwind it without having basically another Great Depression. It's just the leverage in our economic system worldwide is that high. And it's laughable to see bureaucrats talk about this thing in such a willy-nilly manner because they obviously have very little on-the-ground experience when it comes to financial markets and how they actually are working at this point. It wasn't always this way, but as it is now, the system is almost beyond repair. It's almost like we're only going to see major reforms until once things start to fall apart and crash and people demand it. That definitely was an unusual headline to see. They're trying to justify their jobs, I guess, as politicians and showing their ignorance when it comes to finance.
Definitely keep an eye on the story because if they do attempt to implement it, it could definitely be game-changing. We're both in agreement that we find it pretty highly unlikely that this will actually come to pass, or really everything will end overnight, as the leverage and hypothecation is just to such an extreme. And as Eric mentioned, particularly in London, where it's really unlimited. London is actually quite a bit worse than the U.S. when it comes to rehypothecation and leverage.
Technically, in the U.S., funds in, say, a money market fund or what have you can only be hypothecated to the point of 130% of the original deposit. But then, all of these other multinational banks get around that by just taking their subsidiary branches in London and other places and ramping up the leverage over there. It's like a shell game or a house of cards where they're moving pieces around to hide what's going on.
We'll keep an eye on the markets for the next week. Gold closing back under 1,400. Silver off of its lows for the week of 22. We have the potential for a double bottom near 20 in silver. And the big story this week was the failure really to break 20 last Sunday night, even with the big 10% smash. So it should be another interesting week in the markets, Eric. And for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.